Meet Mr. Ghanshyam, who invested all his money in only one mutual fund and now he is worried about his low return. She is Vasudha. She made a good plan and invested in more than 15 to 20 companies, and now she is spending all the time in tracking all those investments. He is Gyari, who thinks about returns all the time and invested in securities that are much riskier than his risk taking capacity. He is Teja, who is very intelligent and received good returns in the past years. When someone asked Teja how can he earn good returns, he replied that he follows four strategies. So let's understand those. But before that, let's understand what is mutual fund. Let's start with the meaning. Mutual fund is a company that collects money from the investors like you and me and invest in equity, debt, or both equity and debt or some other security. In return, mutual fund company earns profit in the form of interest or dividend and distribute those profit with the investors. If they distribute all the profit, what do they get? Mutual fund company for managing funds charges some fees which is known as expense ratio. Let's know more about it because it has a huge impact on the profit received by the investors. Normally, expense ratio ranges between 1 to 3%. It varies from company to company. Let's take an example. If a person want to invest 10,000 rupees in mutual fund company, the first thing he will check is expense ratio. If the company charges 2% as its expense ratio, then 200 rupees is taken by company. The person who handles the fund is known as fund manager. He plays a very important role in mutual fund company. There are mainly three types of mutual fund. The first one is equity mutual fund, the second one is debt mutual fund, and the last one is hybrid mutual fund. Here we will explore equity mutual fund. This type of mutual fund invests in stock market. They try to invest in shares of different companies of different sectors. Typically, these mutual funds are known to generate higher return than any other type. There is also risk associated with these funds since their performance depends upon various market conditions. Equity mutual fund gives opportunity to the investors with wide variety of options like large cap, mid cap, small cap, multi cap, tax saving or ELSS. The next type is debt mutual fund. This type of mutual fund invests in securities which generate fixed income. Securities like treasury bills, corporate bonds, government securities, or money market instruments. This mutual fund earns fixed interest rate by investing in fixed income securities. Therefore, these mutual funds are considered to be low risk investment option. There are few other types of debt funds. They are short duration fund, ultra short duration fund, liquid fund, gilt fund, and FMP, which is fixed maturity plan. Among all these, one of the unique, less recognized and best debt fund is liquid fund. Let's understand in next part. Liquid funds are those type of debt funds which invest in debt instruments with a maturity of not more than 91 days. In addition to this, many liquid mutual fund companies offer instant redemption on liquid fund investment through unique debit card. Liquid funds, as the name suggests, is a fund which can be converted easily into cash. In other words, let's say you have some cash and want to invest for 2 months. After 2 months, you want your cash back. In this case, you can invest in liquid funds as they offer instant redemption and your investment can be converted into cash. The last type of mutual fund is hybrid mutual fund. This type of mutual fund is a combination of equity and debt assets, and sometimes they also invest in gold and real estate. Because of diversification, the portfolio risk can be reduced. These funds are riskier than debt funds but safer than equity. Now, the most important part. 4 strategies you should apply while investing in mutual fund for low investment and higher return. The first one is to start with your financial objective. Knowing your financial objective is very important. Financial objective means the specific goal of a person. Everyone have their own goals. Few people have short-term goals like buying new phone or saving for emergency fund. Medium-term goals like down payment for new home or saving for vacation. And long-term goals like retirement plan or sometimes child's education. If you can achieve your goal in 6 months, then it is short-term goal. And medium-term goal can be achieved in 1 year. And long-term goals can be achieved in more than 5 years. Now you know your financial objective. To take the full advantage of your investment, you should invest in funds that suits your financial objective. For example, if you have short-term goals, then invest in liquid fund or ultra short duration fund or short duration fund. For medium-term goals, you can invest in medium duration debt fund or banking and PSU debt fund. Whereas for long-term, one of the best option is equity. If you are a beginner, then start with any amount as low as 500 rupees and first invest in index funds. Learn from the market movement. Monthly SIP will help you to minimize risk and take advantage of ups and downs of the market. If you are not a beginner, then you can invest large amount and build a mutual fund portfolio that will help you to meet your financial goal, because at the end your overall return matters. Last is doing a periodic review of your mutual fund portfolio, and it is a good strategy. This review should focus on how your investments are working. What to avoid? Avoid frequent changes in portfolio. Just because they are underperforming in short term, you should not change your investment. In case if it lasts for more than 6 to 9 months, then changes should be done by applying all those simple strategies. In a nutshell, they are safe. Investors should not worry about short-term fluctuations in the returns while investing in them. You should choose right mutual fund which is synced with your investment goal and invest for long term. And the important part, check the expense ratio and other charges associated with the fund. Have a look at entry and exit load. Do not invest in too many funds. The last and most important is first invest in knowledge.